day, everybody. My name's Emmett Kilduff. I'm the CEO and co-founder of the Fortia Group. Welcome, and let's get started. So today is the first of our webinars to discuss our relatively new quarterly valuation report. The inaugural report was published a few months ago, representing Q1 of this year. And we started doing these reports because the main question we get asked all the time by either entrepreneurs looking to sell or buyers looking to make acquisitions is, the Fortia Group, you've got a good seat, a good view of the market. What's happening? What are volumes like? What are valuations like? So we decided to productize our IP, if you will, through these quarterly reports. And sending out the reports is great, but putting a voiceover gives a lot more color to our client base, and welcoming esteemed third-party speakers to join me gives it more weight. So here we are. So welcome, everybody. Today's webinar is 3 sections. Very briefly, I'll give you some announcements from the Fortia Group. We'll then walk through the quarterly report. There's a lot to get through. We'll focus on the last section, which is all about where we think valuations are today. And we will give you time to ask your questions and get answers. From a housekeeping perspective, please do submit questions via the Q&A button on Zoom. Please do not submit them via the chat. That makes it very difficult to coordinate. And we're quite open with the questions. You are allowed to upvote or downvote questions that you want to see answered. So please, be interactive in that sense. This full deck and the recording of today's webinar will be made available to all the attendees today as part of a follow-up email tomorrow. So please do circulate that amongst other people in the industry that you think would be interested in the content. Okay, so let's jump in. So the announcements by the Fortia Group. First of all, last month we launched a new and much improved version of our website. It emphasizes what we want to be, which is the leading investment bank focused exclusively on the lower middle market e-commerce sector. So as you know, most of you know, I worked at Morgan Stanley. Our big vision is to become the Morgan Stanley for e-commerce. We're focused on lower middle market, which means we work with companies doing anything from 2 million revenue to 200 million revenue. That's our focus, and all we do is e-commerce. So we focus on this sector day in, day out. And the website's much improved. It positions us as a proper Wall Street type investment bank. We're not a broker. We have 15 client testimonials up there. So please do take a look if you're interested in working with an investment bank. Over the career, my investment banking career, it was often said that to win a mandate to advise an entrepreneur on a sale of their business, the most important thing to do is demonstrate that you know buyers better than anyone else. So we take that to heart. A few months ago, after an offsite, we decided to set up a LinkedIn network of acquirers and also a WhatsApp group to facilitate communication. Delighted to say now that today 102 C-suites of acquirers are members of that WhatsApp group. They're literally all at the touch of a button here on my mobile phone, and that means that we're really close to buyers, which from a seller perspective, is important. I should say, for any other acquirers that are not on that group and are interested, please do reach out to us here at the Fortia Group. The second point I wanted to mention was, we're very active in the market. To give you some examples of that, some sell-side M&A examples where we're acting for the seller. We are acting for a European FBA aggregator. It announced that it was going to market to explore strategic options at our New York conference a few weeks ago, and it's already received 1 formal LOI and 2 IOIs. We expect that to have an LOI signed by the end of next week. So it's interesting to see, there's lots of deals where aggregators are merging with other aggregators. Second example, we're selling a UK house of FBA brands doing 25 million revenue sterling. It also presented at our New York conference, and that was an early look, if you will, and the data room will be ready. The formal teaser will be ready at the end of next week. Really exciting DTC aggregator that is very profitable at the corporate EBITDA level. which is unusual, and it's in the early stages of exploring strategic options. So if that's of interest, please reach out. I'm delighted to say that we're becoming the bank of choice of aggregators, we're delighted with that credential, which shows that aggregators, who a lot of them are ex-investment bankers themselves or private equity, recognize our abilities and are choosing us to do the sale of their non-core brands. An example of that is a US aggregator is selling a $500,000 EBITDA, high margin, over 20% margin FBA supplements brand that's focused on North America. So again, if that's of interest, please reach out to myself or one of my colleagues. Outside of actually M&A, just to give you briefly some other examples, we have several exit-ready projects. So we don't just sell businesses that want to go to market today. We really like working with clients over a long period of time to help them become more exit-ready or viable. One of the brands that will go to market next year is a very high growth pet brand, primarily DTC with some FBA. We also help entrepreneurs to become exit ready and sort of on a one-off basis. So if you're thinking of selling at the end of next year and you just want some guidance to make sure you're going in the right direction, that you're preparing your business as best as possible, we can execute that on a one-off basis. And we do buy-side engagements. We're engaged by a private equity-backed firm in the States at the moment that's going live in 2 weeks. They're looking to source OTC brands, over-the-counter brands. So that'll give you a flavor of the types of deals we're doing. Please do reach out to us if you'd like to discuss any corporate finance-related needs. So our next conference, we were just in New York. Our next conference is in London in mid-September. In New York, we had 75 C-suites of aggregators and acquirers attend. We're looking to have 75 to 100 in London. So acquirers, please reach out and book tickets to attend the conference. It'll be the biggest acquirer conference in our space of the year. Brands, this is a new feature where we're going to have 20 brands given the ability to exhibit and pitch to the room of dragons or Shark Tank type style. So if you'd like to inquire about exhibiting, please reach out. And obviously for service providers that want access to brands or aggregators, please do reach out regarding sponsorship. Okay, so that's thank you for listening to those updates. Now we're going to jump into the main part of today's webinar, where we're going to walk through the quarterly report that we prepared over the last few months. Before we do that, I'd like to introduce you to my fellow panelists. If you would all please turn on your cameras and kindly introduce yourselves.
Awesome. Hi, everyone. Good to be here. Thank you, Emmett. So my name is Jeremy Bell. I am the head of M&A at CellerX Group. So previously one of the co-founders of Elevate Brands. And yeah, we announced earlier in the year the joining of forces between Elevate and CellerX. So yeah, the first kind of large merger of aggregators in the sector. And yeah, very excited to be here. We've got a mandate to buy. So we'll be back in the market in a big way, this year and next year.
Thank you, Jeremy. Zach?
Yeah, thank you, Emmett. Very happy to be here. So by way of background, my name is Zach Flint, Chief M&A Officer at what is now called the Amber Group, similar situation to Jeremy, where predecessor companies of D1 Brands and Suma Brands, two former active acquirers within the Amazon FBA space, completed our merger in late April of this year and rebranded as the Amber Group. And yeah, echoing the comments before, part of that, the strategy behind that merger and the rationale was, it increased the capital on our balance sheet, and we felt as though we were well positioned to start investing and acquiring into a space that, as we'll talk about, I think in a little bit, that has seen some downturns, both in terms of deal volume as well as multiples. And I think there's a lot of interesting reasons for why that is. So I'm excited to get to discuss that alongside the other panelists. But yeah, very active in the space now in terms of acquisitions, looking for large brands, still primarily focused on Amazon, since that's where a lot of our DNA comes from as former Amazon operators. So excited for the conversation today.
Thank you, Zach. Casper?
Hi, Casper Waters. I'm the founding partner of a business called eComplete. We are a D2C aggregator that targets businesses doing 3 million of EBITDA and above, typically in beauty, sports nutrition, mother and baby and pet sector. We probably look a little bit more like a traditional PE fund in terms of the way that we look at deals, but equally we have an operating arm which is now 100 people around the world. So the strategy really is to try and find domestic leaders and grow them internationally. And I think, we're still active in the market. I think it's, a lot of our competitors within the PE space have pulled out. So I think we see a lot of opportunity to keep deploying in the space.
Thank you all. Okay, so the report is structured in as follows. We see 6 key factors that drive valuation: global M&A activity, e-commerce trends, public market comps, e-commerce activity, brand metrics, and deal dynamics. So it sort of goes from macro sector, micro stock or business. So we'll jump into each of these. We're going to spend as much time as possible on the result, which is valuation. I'll give you our collective view where we think the ranges are, both for FBA-led businesses and DTC-led businesses. So forgive me if we canter through a lot of these slides, but you will receive the materials as part of the follow-up. So let's jump in. Global M&A activity. What have we seen? This is from Bloomberg, covers H1, and deal volumes are at levels similar to the start of the pandemic, which isn't bad if you look at the average over a multi-year period, but it's certainly coming off, the highs of the last 1-2 years. So it feels quite negative. There's an interesting comment there by a senior investment banker at Jefferies, just saying like deals are being delayed, boards of companies are having difficulty valuing assets and therefore taking longer to commit to transactions. And coming into the summer, that's going to probably exacerbate, and you'll see a lot of deals pushed to September. So look, a lot of people are being cautious, sitting on their hands. If you look at IPO deals, the first half of this year was the second worst first half for IPOs since the 2008 financial crisis. So very little volume getting done. It's a risk-off mentality. People are worried about the recession either being here or looming, and it's largely consumer-led, which doesn't help us in our e-commerce sector. So people are being cautious. Although it's great to see, I just saw a note before this webinar where Goldman Sachs has just been hired to do the IPO of Liquid Death. Who would have thought that would be a brand that gained traction? And so it'd be great to see that IPO in 2024. So that's sort of deal activity. Let's look at the e-commerce sector. What are the key trends? We wanted to focus today in on sort of VC activity. Ever since the iOS changes about 2 years ago now, a lot of the VCs have been less active in the e-commerce sector. And this data by PitchBook out a few weeks ago, represents that quite well. So you've seen that there's a significant decrease in the volume of dollars going into CPG and the volume of actual deals getting done in CPG. At the moment, it's hopefully we'll get towards that forecast, the white box by the year end, which will make it not look too shabby versus 2019. But there's, clearly we're a good way through the year and there's a lot to get done there. But there's less deals happening in CPG, and a lot of companies on their cap table, their VCs are not following the money. So there's a lot of distress, particularly with DTC more than FBA, and a lot of distressed exits happening on DTC because of that. Interestingly, if you look at the valuations, the impact is on the bigger brands, the bigger businesses that are at Series A or Series B levels. The early stage valuations are actually okay, and it's a good time to be starting something. And but there's hurt and pain for some of the larger guys that have to do down rounds, etc. Any of the panelists want to comment on any of these two slides? Jeremy.
Hey, Emmett, I think maybe just going back to kind of the section before on just the market, and so a couple just observations on kind of deal volumes, and there's a couple ways to look at it, either by value of the deals done or volumes of the deals done. And you know, what I'd say is like, I started my career in kind of 2007. So we rode the kind of that massive peak from 07 when a lot of deals got done, and like you're working on transactions and you know, many would close each quarter, down to kind of 2008 and 2009 where it was pretty grim. What I would say is like, it feels like, just based off my experience then, that like we're kind of at a similar point where everything gets put on hold. There's a lot of like discussions that are just put on ice, and the feedback then is go focus on your business and continue to grow your business. And the real impetus for deals to kind of come back and get done is like, there's a lot of capital on the sidelines. Investors need to feel a bit more confident. And one of the good indications of confidence is like the IPO market is something that's really important. And the reason why that's important is because, you know, for businesses like SellerX, Amber, and like all the other aggregators that raise money, one way for our investors to get their money out is by going public. And so if the public market's fallen away, like that channel there for exit has kind of, you know, disappeared for 2 to 3 years. And that just makes investors, particularly when you're trying to get new money into the business, just pause and think. So seeing this market recover, like the best thing that could happen to the aggregator system is an aggregator goes public and they absolutely smash it. Because that will see a flood of capital back into the space, and you know, that's a good thing for all of us. So I might just pause there.
Yeah. Thanks, Jeremy. Great. Let's move back to section 3, public market comps. I mean, to your point, let's look at the valuations of primarily DTC, direct to consumer brands. This is an index of tens of publicly listed stocks that are DTC led. And you know, the trend isn't pretty, right? You can see the enterprise value to sales ratio has declined significantly over the last sort of 2 to 3 years, as has the enterprise value to EBITDA level. Today, as of the last data point, they're trading at 7.8 times EV to EBITDA. And these are listed stocks, right? So when you hear of a private company, you know, trying to price at sort of 15x or 20x versus what's available on the listed market, you know, it needs to be all relative. If you look at the components, then the valuations, I guess this is obvious, but they vary wildly. What is helpful is the fifth column, which shows you the percentage of revenue that's from DTC. Some of these firms are exclusively DTC, like Smile Direct Club. Some of them clearly are not. Crocs being an example, where it's 58%. Clearly, that's a very large business. But I think it's helpful for the entrepreneurs in our space to be tracking this type of data, seeing which ones are multi-channel, which ones are pure online, what their gross margins are, what the EBITDA margins are, and ultimately what the valuations are, because this is where private deals, you know, get pegged to on a relative basis. Any comments, panelists, on this slide or the prior slide? Casper?
Yeah, I think it's pretty clear from this slide. If you look at the EBITDA margin versus EV sales, I think the focus now is on genuine profitability in D2C. I think that the VC boom of the last 3 to 4 years really funded growth at all costs for businesses that hadn't really proven that the unit economic stack worked. Whereas if you look at the top of this list, you know, businesses like Lululemon, where they have massive brand power, huge gross margin, huge EBITDA margins that are super sustainable over long periods of time. I don't think that is comparable to a lot of the businesses that have been raising money in the VC community, where those EBITDA margins just have never been proven. So I think the best businesses are still attractive multiples, and that there's a long tail that probably, you know, on this list should never have listed, and probably a load of businesses that shouldn't have been funded that have dragged down the, you know, the D2C average overall. But there are still good businesses that at attractive, you know, multiples for owners.
Mm-hmm. Zach?
Yeah, no, I completely agree with Casper there. And one thing I'd add in, like, whenever we kind of work from macro data down to the micro of kind of what we do, it's always important to think through sort of like the mechanism of what's going on. And I think, one thing we haven't explicitly touched on, but is very relevant for both, the macro and the industry that all of us are in, or just what's going on with interest rates. And, for things that are, that are more uncertain VC type bets, some of the charts that we previously looked at, when money is free, it's, you essentially have, an industry that's awash in capital. And that's when you start to see things that are much longer duration, high risk bets, not just high risk from a, terminal value perspective, but also from a sort of, when is this going to start cash flowing? So when Casper says, hey, there's a shift from, things being valued off of revenue to things being valued off of, earnings, that's that's a rational decision. Not all the investor decisions in this market are, but that one's rational because, being able to return actual cash through profit, through working capital efficiency, those kinds of things, becomes much more prudent when the cost of money goes up, versus I can bet on revenue and hope that the economies of scale kick in and eventually this thing will be worth more. So I just wanted to, it's always helpful to talk through the mechanism of how these things trickle down into the valuations of assets that we would look at and we're discussing today.
Yeah. And that cycle will come again in a few years' time. It always does. I started investment banking in the year 2000. I've seen a few of these cycles. We don't seem to learn from our mistakes. So we want to jump into listed aggregators. There are five. We do talk about a big, more recent one going public would be great for the industry. I agree with that. There are five, all that have come from different journeys, if you will. The best performing at the moment is certainly when we press print on this deck is Solo Brands. They're up 57%, 2023 year to date, which is great to see. But as you see in a sec, Tyrion has had a great run this week, which I'll come on to in a moment. There were some positive broker notes on Tyrion in May of this year. Two brokers. When I say brokers, for everyone here, it's small investment banks in the States wrote broker notes on this stock and had buy ratings. Particularly if you look at the rationale, saying the stock was oversold on overseas shipping challenges and the headcount reduction that it went through, puts it in a positive position for becoming profitable. So it's great to see. If you look at the share price, they've had a really big increase just this week. So all these things are good for all of us in the industry. Interestingly, not many people know this, but Go North is, whilst it's sort of a quasi-listed aggregator, if you will, it hasn't done a full IPO, but it does have an investor relations tab on its website where it discloses a lot of financials. In return, then it's able to raise sort of credit in via private investors in a sort of a listed manner, which is different to a lot of aggregators. I just posted it here. It's interesting to see it's doing well. Q1 sales surpassed the full year of 2022. So it's good to see the momentum there, and they've made some interesting senior hires in the last last month. So great to see some positive news on aggregators. If you read the Bloomberg article 6 weeks ago or 8 weeks ago, you might bury your head in the sand. Okay, so we've looked at high level M&A activity. Let's jump into to our sector. Excuse me, this was sort of a high level graph to look back. We will look forward, which is more positive, but just taking a step back, this is a good chart by Global Data, a listed company itself out of London that tracks a lot of data on sectors and so on. And it's a good summary of both by volume and by value. Unfortunately, the M&A in sort of consumer and e-commerce has declined significantly, but it hasn't dropped to zero. There are still deals getting done, and we'll show you many of those in a moment. As you know, if you've seen our Q1 document, we are looking to build a small database of the deals that have got done in the e-commerce space. By no means do we have all of 2021, which was the bumper year. A lot of acquirers, frankly, are shy to give us their data. But we will keep scouring and keep looking to build on this list. And I think it's helpful to see which strategics, which private equity, which aggregators have been doing what type of deals. 2022 was when it started to change. So I think the peak of the market was December 2021. That's when the high valuations were. We did a deal in April that had 12 LOIs, and then the market started to turn. The second half of last year was really tough. It was the worst time for M&A in 7 years. Thankfully, the first half of this year has been certainly better than the second half of last year, and there's some green shoots. It by no means has the market recovered, but there's a decent list of deals here that are getting done, and we'll go through a few of these in more detail. If you've done a deal and you would like to be added to this, please do reach out to the Fortia group. The more data points we have, I think the better for the industry. So let's just jump into 4 of these. And again, oh, sorry, Jeremy, your hand is up. Apologies.
Yeah, I think I just had an observation just back on the kind of chart of deal volume and kind of so this is I think this is a cool chart because it does kind of map, certainly the kind of the world that Zach and I definitely lived as we moved through 21. So if you think about the market, these charts basically perfectly correlate with the amount of money that aggregators raised. So if you look at what happened in kind of the end of 2020, moving into 2021, that's when there was a lot of new aggregators. Every week there was an announcement out that, X group has raised $50 million in committed debt and $10 million of equity. The announcement read like they'd raised $200 million because, everyone was kind of overinflating the figures. Q3 for us, and based off some of the data from other folks that we've seen in the ecosystem, was definitely when we just saw multiples go crazy. So single SKU businesses selling for kind of 5 times SDE off adjusted figures, which didn't quite make sense. But the bad thing though is like that was kind of peak container price exposure too. So you're buying these businesses paying top of market multiple of earnings that were about to get massively kind of slapped.
Mm-hmm.
And so we saw that was a period where I certainly looked at it and said, look, I think this market's going a little bit nuts. And then Q4 kind of settled down. And for us, that's when we did our best deals at the best valuation. And then, Q22 was either people kind of trying to raise new capital and not having money to deploy. And that's when we started to see valuations decline and many failed sale processes.
Yeah, thanks for that color, Jeremy. Please keep jumping in, folks. If I don't see your hand, please just interrupt me. Okay, so just very briefly, I just want to give a snapshot of four of these deals that happened in the last few weeks, just to show that deals are getting done. So we can have a positive outlook. So we have one by a strategic, 2 by a private equity firm. One by a strategic, 1 by a private equity firm, and 2 by aggregators. So this is an example where a strategic called Great Jones. A strategic called Meyer acquired Great Jones. Great Jones is a DTC millennium-focused homeware brand, so unfortunately, the specific details of the acquisition are not disclosed. But it's great to see a deal in this category. This category, from what we've seen, hasn't been sort of the top of the list of a lot of acquirers. Certainly aggregators, but obviously a strategic comes at it with a different lens. The second example, is a private equity firm called Transom Capital Group acquired Aiden and NA. Transom is a middle market PE firm in the States, and it acquired this brand. It's very much an omni-channel brand, not just DTC or FBA, sells through various channels, including retail. Again, the details are not disclosed, but it's good to see private equity, doing deals in our space, and they have a huge amount of dry powder to do deals, which we'll touch on later on in the webinar. From an aggregator perspective, there are 2 deals recently. Society Brands out of the US acquired Wolf Tactical. This was announced, I think, in June. It's leading tactical gear company based in New Jersey, doing range belts, weighted vests, etc., etc. So congrats to the Society Brands team on acquiring that brand. Then finally, this was just announced yesterday. Certainly on LinkedIn, Matt Rhodes, the head of M&A at Foundry, posted this advert, which was Foundry, again, US aggregator acquiring Blue Atlas, which is sort of doubling down on men's grooming. I think it's their third acquisition in that space. But it's good, it's good to see. A lot of people, again, would think aggregators are not doing deals. There's two examples. And we have, two people on the call that have just done big mergers and have a mandate to buy deals, right? So let's be positive that there are more deals are getting done and will get done. I thought this was interesting. This is taking a big step back and looking at history, but I think is important to look at. So if you go back to the Great Recession, the consumer product winners coming out of the Great Recession, used inorganic strategies to really get ahead. And so I put this in here because I think strategics that have thoughtful M&A strategies, as well as private equity and aggregators, but certainly strategics, and they have lots of dry powder, are going to make some big bets, either like they've recently done it or are going to do it, or frankly should do it, because now's the time. It's a great time to be a buyer. This is when Buffett moves. Hopefully less people will sit on their hands in all those board meetings we were talking about at the top of the call, and will actually make thoughtful decisions and acquisitions. So, and maybe even to some of the smaller entrepreneurs on the call, e-commerce businesses doing singles or tens of millions, it's worth thinking about your own inorganic strategy. You don't have to sell now. You don't have to maybe raise equity now. You could think about buying a competitor, or buying an adjacent business where there's good strategic, financial, operational rationale to increase your own shareholder value, and then selling. Okay, so then let's look into brand metrics. So those first four things are really outside the control of the entrepreneur. The next two items, brand metrics and deal dynamics, are more within the control of the entrepreneur. So obviously there's a huge amount of brand metrics to think about, whether you're an FBA or DTC business. Let's look at FBA first. We have, for the last 2 years, have been publishing a guide, an exit guide for Amazon FBA entrepreneurs. It's a 78-page guide. There's contributions from about 20 acquirers in it. You can obtain the guide via our website. In that, we have a whole section on what buyers are looking for, in terms of a very simple checklist there, but you go into lots of detail. So high level, what sort of revenue, what sort of items, what they want, but we also give detail and quotes and examples. So for the FBA folks on the call or watching this recording, please, if you want to dive in, take a look at that report. We have the same thing for DTC. So we published our first DTC guide a few months ago this year. That's a 90-page guide. Again, lots of contributions from various experts, service providers and acquirers. And we go into detail as to what buyers are looking for and what people should be striving for from a metric perspective, both financial and operational. Okay, so let's jump into deal dynamics, and then we will leave the rest of the webinar for valuation. So from a deal dynamics perspective, there's a couple of points to think about. One is sort of supply demand. We've touched on this before. Obviously, there's a correlation between the amount of capital raised, correlation between interest rates, the amount of capital raised, and the valuations bidded for all these brands. Clearly, it's tailed off in the recent past, but there has been, again, some good news in H1 2023. Go North did an equity round and a decent credit round. Intrinsic did a good equity round. Kite did a massive equity round with Blackstone. CellRx has and Amber have both obviously done mergers and acquisitions and have raised equity and credit. So there's a revival, if you will, of the aggregators. Jeremy, go ahead.
Yeah, so I think this chart, I think this chart kind of like nicely illustrates the point I was making before around when valuations peaked and like M&A deal volumes. It's actually probably the light gray bars that you have at the back, which is, when each of these announcements came out, when the capital was raised. That, if you think that people raise capital, it then took kind of 3 to 6 months to deploy it. Like, you can see a lot of a lot of money was raised in kind of Q1, Q2, 21, and then deployed over the back end. So of the money that has been raised, it's not like a lot of aggregators have a ton of cash sitting on their balance sheet. You know, there's a lot of debt sitting on their balance sheet, which needs to be kind of serviced and interest needs to be paid. But it's the kind of cash point of having pure equity on your balance sheet that you can then go and use to kind of further deploy that is the difference. So yes, seeing more equity raises is absolutely positive. You know, there's two things happening here. One, it's capital to grow, and then two, as aggregators get to that kind of inflection point where, you know, their businesses are profitable, they kind of even they generate free cash flow for themselves, like that will self-fund some of the M&A, and I think that's when that is the impetus for a lot of folks to kind of you know, start to kind of reinvest in the space and kind of, you know, write checks back into aggregators.
Yeah, fully agree with that. Okay, so that's aggregators. Obviously, there's other types of buyers, private equity being one. We included this in our last report, but I you know, the trend is very much the same. You know, to Zach's point, interest rates were crazy low, artificially low for a long period, allowed these private equity folks to raise huge funds. They have a lot of dry powder to put to work. A significant amount of dry powder. Even the smaller and medium-sized PE firms that look at consumer, CPG, and e-commerce. So obviously you have to be a certain size to earn the right to pitch to private equity as either a platform exit or a bolt-on. But something to keep in mind for sellers, depending on their size. Wanted to include, sorry, Jeremy, go ahead.
Yeah, so I think the exciting thing on this slide is there's a lot of money sitting on the sidelines, and so, you know, some of the hedge funds that are on our cap table, like when you go and speak to them and you're like, what are you guys doing? They're like, look, we're not investing in anything at the moment, won't do so for another couple of quarters. And we're like, okay, that's strange. Like, why is that? And there's kind of the consistent response is, one, we're not sure where inflation is going to head to, because, you know, higher inflation means higher interest rates. Higher interest rates, you know, means lower valuations for folks. So like people aren't, you know, sophisticated investors aren't sure how to deal with that uncertainty. And then also, like, there's, you know, the US consumer has been pretty strong, and folks are scared that there's potentially going to be a recession. So they're just trying, you know, taking more of a wait and see approach as to what they do. The other thing though about the names on this list is we've spoken to a bunch of them, and like when you go and meet them, they're like, look, we don't really get out of bed for, you know, $200-300 million. So grow your business and come back to us. So I think that in a way, like some of the names, particularly at the top of this list, you know, a couple of them have written checks already into this sector, but if they do, you know, when the time is right, kind of re-engage, there's a lot of capital that will come back into this space, you know, pretty quickly.
Yeah, and I look, these are huge names that are more likely to invest in very big brands or aggregators, but there are smaller and medium-sized brothers who will look at smaller brands as well. So the theme is good, but people are definitely sitting on their hands as well. Casper.
Yeah, I think the problem with this slide in terms of just looking at pure dry powder across the PE and, you know, hedge fund sector as well is that there's opportunity cost for deploying into consumer. When we speak to private equity, a lot of them are saying, well, less than 1 in 10 of our deals at the moment are in consumer, and we suspect that number will become, you know, 1 in 20. And when I talk to the hedge funds that we work with, a lot of them are saying, well, look, we're getting offered 15-16% on secured, you know, debt. Why would I deploy equity check into something that's going to return less than that? So I suspect that even though there is a lot of dry powder, it's going to be very, very hard to get it out of people in the next 6 or even 12 months into a sort of traditional equity style deal with, you know, limited downside protection or limited, you know, fixed return.
Yeah, fair point. Zach.
Yeah. Just final comment, I guess, on this. It's, you know, when we talk about Blackstone and Thoma Bravo, like you know, my eyes start to glaze over just because, you know, they're not as relevant to our industry. So I can't imagine some of the entrepreneurs on this call, you know, wondering what the relevance is. And I think the relevance is, you know, kind of what we've been talking about this whole time is that, you know, these are the folks that are allocating capital in the private markets for the most part. And so, everything is to some extent downstream from that. So, I think when what Casper said is definitely true. There's a lot of competition for dollars depending on what sectors are hot. I think if you were, an AI aggregator, you'd be getting a lot of that pie because that seems to be where everyone wants to invest. And in an inflationary environment where we've seen a big whipsaw on consumer demand on Amazon and elsewhere, a physical products, company or portfolio of companies just is relatively less attractive. So, I think those dollars are looking to, find people in the space. We saw, upwards of 100 aggregators looking to deploy capital, as short as 18 months ago. That number is no longer 100. It's likely less than half of that. And so I think a lot of these capital providers are waiting to see who the winners are going to be, who has a strategy that's durable and can protect, capital that they invest going forward. So it'll become relevant, but for right now, I think people are still very much in a wait and see mode and investing in other, hotter technologies, hotter investment criteria.
Oh, is it? Okay. But it's interesting that the number one firm on that list just backed Kite with 200 million equity. So, some of these names are important to our space.
Yeah.
Okay, let's move on. So just wanted to show that there's this is at the smaller level. A lot of those names were at the very big level because you can get data about them in an efficient way. It's hard to get data about the sort of smaller and medium-sized e-commerce orientated private equity firms. Here's some examples though of firms that are raising funds to invest in CPG and e-commerce. So it's good to see that they're able to raise money despite a really, really tough environment. It's a great time to be an investor or an acquirer now, right? Because there's good valuations. Okay. Other examples, just while we talk about deal dynamics, I'm not going to go into these, just mention them very, very briefly. Obviously, it depends on a huge range of factors in terms of the dynamics of a deal and what that might mean to valuation. What's the shareholder situation? Does a shareholder just have to sell? Maybe they've fallen ill. What's the acquirer situation? Have they just raised money, or are they fundraising and have to deploy money right now? Has the seller retained an advisor? There's data to show that they get higher valuations. What's the marketing and distribution strategy? If it's a large firm, you would encourage the entrepreneur to go to all types of acquirers and not just one bucket. What are the synergies available? Strategic, revenue, operational type synergies, and what's the deal structure? How much does an entrepreneur really want as much as possible up front versus less upfront and more deferred? And all of that impacts valuations. And we don't have enough time to go into that in detail, but please do think of that. Think of those points as you look to do a deal. Looking ahead. Again, we had this in our last report, but wanted to repeat it because it's very much still relevant. This was a survey done of hundreds of PE firms, and the biggest challenge the PE firms saw to completing deals in the next 12 months is the sort of expectations of the seller about valuation versus what buyers are willing to purchase based on sort of the latest trends in the market. I think a lot of entrepreneurs have become more realistic on valuations in the last maybe 3 to 6 months. It took a while to sort of recalibrate, but most folks are not trying to expect valuations that were seen in December 2021, and nor should they. That's just the way the world has moved on. Okay, so the most important section, valuation ranges. Let's jump in. So if we look back. We'll take FBA brands first on the left, and then we'll look at DTC brands. FBA brands before the correction, in sort of Q2 last year, were trading at between 3 and 7 times, and 7 times were very much the diamonds. Very few, if any, got above 7x seller discretionary earnings, and this includes upfront and deferred. For our Q1 report, based on all the deals we're seeing. Conversations with folks in the market, buyers and sellers, we published a range of 2x to 4.5x, and in the last week or two, we've been looking to get intel from the market again to think about that range, whether we should increase it or decrease it, and frankly, it's stayed the same. We have the diamond icons above that because there are always exceptions. Frankly, there's exceptions to the downside. There are very distressed deals happening below 2. But the deals are possible above 4.4, and we'll discuss what makes a diamond in a few minutes' time. On the DTC side, DTC typically get higher valuations because they own the customer. And pre-correction, our range was 4 to 12x. Casper will point to examples significantly above that for diamonds, which you can touch on in a moment. And then in the last 2 quarters, we've seen that come down. It's very wide. It's unhelpfully wide, but we sort of, it's hard to have it narrow at the moment because there's a huge range in the DTC world of distress of great companies with high renewal rates and things like that. So it's sort of unhelpfully wide, but that's what we think, and what sort of all the people we speak to think is a fair range. So we'll jump into Q2 in a moment, but just in terms of the trend of what we're seeing from historic to today, I'd love to hear thoughts of the panelists. Casper, over to you.
Sure. I think in DTC it's very specific to subsectors, and the best way of judging whether you're going to get a premium multiple is looking at the likely end acquirer after the cycle of financial investors. So if you look at where, say, beauty, large scale beauty businesses like L'Oreal trade, it's at a significant premium to the rest of the sort of consumer discretionary market, and therefore there's confidence within the private equity community that those businesses are going to be acquired at a positive multiple. And I think this slide is super interesting. I think people in PE think they're very clever, but when you look at this, it probably indicates that they're not, on the basis that more than half of returns in PE are generated by multiple expansion. So they have to be buying significantly below where they think they're going to be exiting, and that can only really be done with scale or by selling to somebody who has a super premium multiple themselves. So I think it's very sector dependent. At the bottom end of D2C, the problem is that debt makes up a bigger proportion of the overall transaction volume or transaction value. And when interest rates now for that kind of debt are double digits, it just completely blows the LBO model. So in reality, while yes, valuation multiples have fallen from 12 to 10 at the top end, I think deals just aren't getting done at the bottom end on an EBITDA valuation basis. They're being done on a basis of real asset value. So that will be stock and a brand value. These are not two times, 4 times. Those are not sales of solvent businesses that people are excited about. Those are trade buyers taking things for asset value.
Mm-hmm. Thank you, Casper. Right, so let's focus in on where we are today then. Again, to be clear, we're saying FBA brands are 2 to 4.5x and D2C are 2 to 10x. There are exceptions, which we'll come to in a moment. What we've talked about today to get to valuations is 6 things. The first 4 are relatively outside the control of the entrepreneur: global M&A activity, macro or sector trends, sector comps, sector M&A activity. However, the last 2 sections are more under control. So how is the brand actually doing, and affecting the deal dynamics? So that's where we are. Jeremy, Zach, what are your thoughts on these ranges, please?
Happy to go first. So on the FBA side of things, I think that's probably feels about right. So if you look at where companies were kind of trading back in 2019 and kind of 2020, most of the things that I bought back then was 2.5 times. That was it. I'd say the difference now though is that, like, for larger assets, your ability to sell that business is greatly improved, and there's just a general concept that scale, larger earnings base. Back to the kind of point that Casper made on that other slide, is like, the larger your earnings base and the bigger your company is, typically you attract a premium in terms of just valuation for size. So in terms of, like, if you're sitting there as an entrepreneur thinking, like, how do I get my business to 4.5 times? I think that there's a lot of things that kind of feed into it. It depends on the buyer and what they're really looking for, and like their strategy and how your business fits into it. But there's a lot of kind of points here on the slide. I would just say have a great business, and have a great business that has strong fundamentals and can kind of continue to grow without you. And they've typically been the ones that we've paid up for, and the ones that have done very well for us. So I won't dive into this slide too much because I know Zach needs to talk for the valuation ranges, but yeah.
Okay, thank you. Jeremy?
Yeah, I mean, I can just kind of provide quick thoughts. I'm not surprised, honestly, to see that the range has widened. There's a Tolstoy quote, which I didn't think I would be dropping Tolstoy today, but it's all happy families are alike and all unhappy families are different in their own way. And like, I think that very much applies to any M&A market, but particularly ours. When there's tons of capital in the market, everyone's buying, the range will start to tighten, and it'll be sort of a clearing price where everyone's trying to kind of just outcompete the person who's trying to buy the company. And you kind of see every business, for the most part, every category kind of go up in unison, because really it's, kind of a land grab where everyone's trying to build scale, capital is really cheap. When that reverses and we've entered the period that we're in now, you start to see people being a lot more discretionary. So there are businesses that can definitely sell for 4.5 times, but it's really, there's not a one size fits all. I think the best indicator of that is how well suited is your particular brand to the focus area and capabilities and competencies of the buyer pool you happen to be talking to. And with a much smaller buyer pool, that just means that there's fewer at-bats for something that's idiosyncratic and might be, a gem in someone's portfolio. You just may or may not have that person be acquiring at that time. And, I think the aggregators, Jeremy and ourselves, and certainly others who are still around and still kind of acquiring, have done a lot to try to diversify and try to become sort of like unique in the way they approach the market and how they operate, which just necessarily narrows the box of things that we want to go out and acquire. But it doesn't, but for those things that fit the criteria really well, I think multiples can still be pretty attractive. And so that's what I would kind of say to like the widening of the range. I think that's why we see that dynamic playing out, in a what we could call like a bearish market.
Yeah. And I think the other thing I'd say is like aggregators now have a lot of like track record of what's worked for them and what hasn't. So what works for seller X may not work for Amber. And that's really the role, is like, if you're trying to sell your business, you've got to try and navigate that yourself and find the business where you're the most complementary, or where your portfolio is going to do the best. So that's the other thing to just round out on, just the multiples and the state of the market.
So let's build on Jeremy's very sensible one-liner of business advice, which, like, build a great business. Let's encourage the entrepreneurs. Like, if you guys owned your own brands, what would you be trying to do to be priced as a diamond? Who wants to go first? Casper?
Sure, I think beyond sort of key financial fundamentals, what we're really focusing on at the moment is new product development and differentiation. I think a product lifestyle cycle can be relatively short, whereas the highest valuation businesses have had very, very long life cycles because the brand has remained resilient. And I think as investors in the space, the best way that you can guarantee that is by finding a management team that have continually demonstrated their ability to innovate and connect with a customer base in a way that their competitors can't. And I think there's a lot of the noise in the sector and a lot of the pain that's being felt in the sector is because of a lot of Me Too businesses that are piggybacking on other people's innovations. That's just completely uninteresting. You end up fighting a price war immediately, margins contract, and you end up in the state that some of the worst performers in our industry have found themselves in. But I think the people who are still genuinely innovating products are going to keep winning and are going to keep being attractive to acquirers.
Agreed.
Yeah. What I would say is, and really, let's kind of go back to my previous comment where there's, I'm not sure the same pitch is going to be the same for every single buyer, but I can tell you sort of like what the perfect pitch looks like from my perspective. It's somebody who has a brand that they know intimately. So, every question that, a buyer might be interested in while they're trying to get up to speed, trying to learn more about your business, you have a good answer for, you've thought about, which I think most people will just kind of do naturally. You have a product that is clearly in demand. Whether or not the sector or the category is in demand, I think is a little bit more agnostic than, within that sector, you're consistently ranking well. There's a demonstrated pattern of people wanting to buy this over a competitor for XYZ reason. And then there's the third thing is that there's, multiple identifiable catalysts to be able to grow the brand post-acquisition. And whether that means you're kind of staying on to help the acquirer, pursue those growth paths, or, you're kind of teeing them up for that. We really like to see sort of growth levers that are in our control as buyers. We can't really help what search volume does a year from now. To some extent, we can't help what competitors price at, but what you can control are things like, having a fairly robust product pipeline, as Casper mentioned, and having that kind of like a lot of that legwork done. You can control, securing the best COGS within your market to make sure that you're always competitively priced. You can control branding, all the things that kind of go into differentiating you amongst competitors. I think having that sort of locked down, but also some further meat on the bone for the next buyer to kind of go pursue, because when you kind of build the brand to its utmost scale and there's not really much more to do except for launch new products and hope search volume goes up, then I think that's when you start to see the inflection point of multiples coming down, even though you've presumably built a really strong business, because there's just not that much left for the buyer to do in terms of growth. So that would be kind of like what excites me to pay a premium multiple.
Yeah, thank you, Zach. Jeremy?
If it were me and I was starting again and going back to running an Amazon brand, I would pick a category and I would know, kind of to Casper's point, like the innovator wins. So when you get to where I am, it will be where I was because I've made 2 steps forward. So pick a category, know more about that customer than everyone else, and build a brand around that kind of vertical. These are the things that I get quite excited about. So product development is key. Initially product development is key to kind of diversify your revenue streams, build a team out. So I get very excited when I see a business with a team that's kind of, committed to the business. What Zach said before. So make sure that you've got other growth levers where you've got some early traction points. Like I think that the days of meeting a seller where it's like, well, how will I grow it? Oh, you can expand it into, Walmart, eBay, Canada, and like other Amazon markets. Like those that doesn't really carry water anymore with any buyer, I suspect. So like you've got to have some proof points that those growth levers are real. So if Costco reached out to put $1 million PO, show us the PO, and that gets us very excited. So just demonstration. Then the thing that I would do is, like, if it were me, I would stick around for 2 years post transition. And I would command to kind of higher multiple on the back end for the second or the remaining buyout. So anytime we've seen a deal where the seller is willing to stand behind their business and kind of demands that sort of deal structure, like it's generally a flight to quality because the entrepreneur knows what they have, and they've been our strongest performers. If I meet a seller and it's like, look, like I want to walk away, I'm done. Like, yeah, I'm kind of done too. So unless it's a complete slam dunk for me, then you know more about this than I do. You've been running this business for 3 years. Like that just starts to make me fairly nervous.
As long as the earnout is clear, fair, and will get paid, and you can convince them that it'll get paid. Speaking.
Yeah, it takes time. Like those types of deals take time. It's not a kind of 2 to 3 month process. It takes longer. It's more of a marriage than we kind of describe it as a marriage. So yeah.
Big believer in flirt, date, marry as a concept in personal life and business life. Brilliant. On that note, thank you to all the panelists, Jeremy, Casper, and Zach, for your time today. If anyone has any questions, please ping inquiries at thefortiagroup.com. Have a super day. Thank you. Bye-bye.
Thanks.
Thanks, everyone.
Thanks all.